three methodologies to valuing a company. Now, when I value a company in the many IPOs I've worked on, we don't just use one valuation methodology. Because what if your target price using one methodology is wrong? Well, if we use three different valuation methodologies, then we get the target price of all three. And if we take the average target price using the three methodologies, then what we do is we minimize the margin of error. The reality, though, is that investment bankers don't know exactly how to value an IPO until the last day when the company goes public. For example, in my hand here is the Facebook IPO from many, many years ago. It's also called the S1 document. And I invested in Facebook when it was a private company in my venture capital fund before their IPO. And I love using real life props to teach. This might be a little bit tricky to see, but on the cover here, there's a gap. The thing that's not listed is the price. Everything is here except for the price. And so what happens is investment bankers will create things like this to help their clients, meaning big mutual funds and hedge funds, value companies. And they'll use three of the methodologies that I'm going to talk about today. The first is price earnings, okay? That's PE for short. This is the best way to value a company. So what we're going to do is we're going to learn using a lot of props today. So when you value companies using PE, you value companies based on price divided by earnings, okay? And it all comes down to a simple equation. And for the rest of your life, when you see a fraction in finance or accounting, I want you to always think of the denominator as being the number 1, okay? And I want you to think of the numerator as being a multiple of 1, okay? And this will make more sense to you in a second. I promise this will help. So for example, if you have earnings of $1 and a price of 10, then that means the company has a PE of 10. It means investors are paying for a stock price of $10 for every $1 in earnings. So for every $1 in earnings, investors are paying 10 times. So let me set this up here. Cool. Now, why would I pay more than 10 times for a PE? Meaning, why would I even think about paying 20 times for $1? Why would I do that? What's the point? Well, I'm going to explain why in a second. I'm going to give you a very simple methodology for valuing any companies using PE. Now, the reason you would pay more for this is because it's growing faster. So, and soon we're going to talk about this big secret brick behind me here, Lego block. And my son Dylan, I promise him he gets all these toys when I'm done here. But how do we know what to value a stock at when it comes to price to earnings? Well, it's all relative, actually. But the S&P 500, it represents 500 stocks that trade in the US markets. And historically, the S&P 500 trades at a PE ratio of 15 times. Okay, so for every $1 in earnings, the average company historically in the S&P 500 trades at 15 times that $1 in earnings. Now, the company at a PE of 10 times has earnings growth of only 10%. Okay, this will make a lot of sense in a second. I love this. And this company here that is trading at 20 times earnings, in this example, it's actually at 20% earnings growth. Okay, and we're starting to see a pattern here. And for the S&P 500, the average S&P 500 company grows at 15% earnings growth. Okay, so the pattern is making sense here. Now, if we look at the price earnings here for the S&P, okay, it's 15 times. And so what we can do is we can actually rearrange this so that we've got the price here divided by the earnings growth. And you'll have this great aha moment in a second here. Price, it's fun doing this live. I like the challenge. Price divided by earnings growth. Great, here we go. Awesome. Cool. All right. So if we take the price divided by the earnings growth, okay, that price earnings ratio 15 times divided by the earnings growth, then what that means is a PEG of 1. Now this will focus on my face. I'm going to move in a bit here. Hey there. How are you? I don't mean to be in your personal space here. But basically, a PEG ratio means a price earnings divided by growth. And so the price earnings ratio of the S&P 500 is 15, and the earnings growth is 15. So PEG, price earnings divided by growth, is 15. And the same thing holds true when it comes to, and I dropped one of my bricks here. Give me 1 second, guys. Yeah. The same thing holds true when it comes to this company. This company here has a price earnings ratio of 10, and it's growing earnings at 10%. So it's got a price earnings divided by growth rate of 10. And this bad boy up here has got a PEG, or price earnings to growth rate, of 20 divided by earnings growth of 20%. So a price earnings to growth rate of 1. So these companies here are all valued based on how fast they're growing earnings. So when we use PE, it's all based on growth. And when I used to work in the hedge fund industry, I would buy stocks with a PEG ratio below 1 if I could find them. And buying stocks, oh, by the way, so buying stocks when it comes to hedge funds, it's called going long, okay, going long. And the opposite of going long is going short, meaning you make money when the stock goes down. So when I was in the hedge fund industry, I loved buying stocks with a PEG ratio at or below 1. And I would short stocks that had a PEG ratio above 2. So if a company had earnings growth of only 10% and it traded at a PE of 20 times, then if you take a PE of 20 divided by a 10% growth rate, then the PEG, meaning price earnings to growth, is expensive at 2 times. And some of you might be thinking, okay, this makes sense, Chris. But if a company is in the red and they don't have earnings, how do you value unprofitable companies that are public or private? Well, in that case, we look at what's called a price to revenue multiple, okay? And so you take the price, and instead of looking at earnings, you look at revenue, okay? So I'll go here, price divided by revenue. A lot of moving parts here, okay? Price divided by revenue. And it's a simple concept and quite similar to PE. I got to change this bad boy here too. All right, so I'll go here. You're gone. You can stay. Price. Then we'll go here. We'll come back to these bricks here later on. So this here is a price of 20 over revenue, okay? So our second methodology here is price divided by revenue. And remember, the denominator is always the number 1, okay? So for every $1 in revenue I have, how many times are investors paying for that $1? Turn this around here. Great. Okay, cool. Remember that. The denominator is always 1. Okay, this will help you out a lot, especially when we talk about financial ratios in a little while today. So if one company is growing faster than another one, it should trade at a higher price to revenue multiple. And with price to revenue, what we do is we compare it to other companies in the same sector. It's all relative. Okay, so in the summer of 2012, I invested in 3 major IPOs. One was a company called Workday, ticker WDAY. Another one was a company called ServiceNow, ticker NOW. And the third one was Splunk, ticker SPLK. And at that time, those 3 software companies were not profitable during their IPOs. And the going rate then for a cloud software company when it came to valuation was 15 times revenue. Meaning, for every $1 on the denominator, investors would pay 15 times that $1 in revenue. So with price to revenue, it's all relative, not only to revenue growth, but more importantly, to what comparable companies trade at on a price to revenue multiple basis. So now we know how to value companies using 2 methodologies, price earnings and price to revenue. Now, what about looking at earnings and revenue together and cash flow? What is that all about? This is me buying time trying to set this up fast. Here we go. Great. All right. So the third way to value a company is to create a financial model and forecast the next 20 years or so. Okay. And when you do that, over 20 years, you're going to make a lot of money in the company, hopefully. And then what you do is you take all the cash that you make, which is basically earnings, okay? and you discount it back to the present value of what it's worth today using an interest rate. Okay, I'm not a big fan of DCF, but I'm exposing you to a lot of different ways to value companies and analyze companies.